Hey, everybody. Welcome back to Value After Hours. I'm one of your hosts, Jake Taylor, and Happy New Year to everybody. Toby, what do you have for us today?
I'm talking about the fact that the entire stock market is loaded to the gills on one side of the boat. Everybody's super bullish for the brand new decade.
Bill, what do you got?
We're going to talk about three bullet points from a 100 bullet point thread that Lizz, the handle on Twitter is at LA Forever Hall, had tweeted out that were very thought-provoking.
And I'm going to be going into some New Year's resolutions. And then we're going to wrap everything up with a mailbag that had some really good questions in it. So
Big mailbag.
Big mailbag for the new year.
Right after this.
Tobias Carlisle is the founder and principal of Acquires Funds. For regulatory reasons, he will not discuss any of the Acquires Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquires Funds or affiliates. For more information, visit acquiresfunds.com.
All right, shall we kick it off with New Year's resolutions? Have you given it some thought, Jake?
I have. My personal New Year's resolution is actually springs from an article that came out from the BBC here recently, and it was called "How Busyness Leads to Bad Decisions." And really, the idea of it is that we all, when we're under pressure, we start to kind of get tunnel vision, and we work on little stuff that makes us feel good about making progress, but we're not seeing the bigger picture and working on the things that will really unlock the magic. And so, especially for me, I find that email is my arch nemesis when it comes to this. I get to feel so productive. They actually call it an attention slot machine, because it's like, yeah, you go in and see if there's anything important you need to work on, and you're letting everyone else set your agenda for you. I spend way too much time in email. So their recommendation was to actually schedule time to sort out your email and not have it just be open all the time. I think that's really smart. So that's what I'm going to work on. They also had some other tips about treating your life a little bit more like an art gallery and less like a pantry that you're just trying to stuff full of things. So, you curate
I like that.
an art gallery. Everything's laid out for a reason. There's a flow to it. The same concept can be applied to your schedule and not letting, every single thing be in there that doesn't deserve to be there.
I'd like to know if these people have kids. That's my one my one pushback to them. Like, oh, that's nice when I wake up.
Yeah.
Come 5:30, all that changes.
Paul Graham has a great post on the creator time schedule versus someone who's reactive. So he says you just got to, because it takes a long time to get, if you're writing, for example, you have to reread what you've written, and then you have to start writing. So it might take an hour to prepare. Then you might get an hour or two of productivity before you need to take a break to do something else. So you need blocks of time rather than short periods. So he says you have a morning and an afternoon, and morning might be get all of the stuff that's hard to do done, or get the thing that you want to get done in the morning. Then the afternoon is all for meetings and busy work and email and everything else. And that's a good schedule. That's what I do.
Yeah,
Tim
Daniel
Ferriss had a good one on that. He said, like, especially if you're junior, it's sort of hard to do this. But to try to articulate up front to your bosses, or, if it's our role or whatever, if it's a client, and just say in the email body, it's almost like it's pre-written, and you say, in order to do what I'm doing for you best, these are the blocks of times that I've scheduled to respond to you. I'll be working between these hours. If you really need me, you can call on my cell or something like that. Sounds better.
Good luck with that one.
That's what I'm saying. Yeah. Had I done that at the bank, they'd have been like, oh, that's cool. Call me right now.
Yeah, and the law firm would have been the same. They're just like, yeah, that's my schedule. That's why you don't have one. You just do what I ask you to do.
That's right. Yeah.
When I ask you to do it.
I don't know if you understand the roles here, sir. So might be better in a book than reality, but there's probably something to borrow from it.
Do you have a New Year's resolution?
Paul Graham called it the maker versus manager schedule.
That's it. Yep. Do you have New Year's resolutions, Bill?
Dude, everything's perfect, man. No. I have gotten a lot this year out of creating content. I hope more of it's good than bad, but I'd like to continue that. I've gotten from this podcast. We joke about the amount of followers, but I found them to be more than I thought they would be, and really thoughtful and engaged. People have written me about things that I've said, and I'm appreciative of that. And it's made me look at things in a different way. And, I'm going to try to prepare for this, continue doing a good job on this, and then I'll probably try to up the frequency that I'm writing on the blog and maybe decrease my Twitter frequency a little bit. So that's most of it. I mean, I don't know. I got to put together a 3 and 5 year plan and stuff like that. But right now it's just keep everyone alive and treat my, family in a way that makes them not resent me on a couch somewhere someday.
Yeah, you're in the survival period, with that many under 5.
Yeah.
Both you guys.
Yeah, I have something similar. Just like get more handsome, get richer. The usual. No, I don't have any specific resolutions.
You get a better accent. Oh, it's perfect. Sorry.
Yeah, I think that it's a little trap waiting until the end of the year to get the resolutions. It's all this pressure, and then you mess it up, and then you got to wait 12 months. I think as soon as you have the thought, you got to start putting it into practice, and know that the first. I mean, I think, in relation to anything, podcasting, whatever, I think that you just got, if you want to do it, you just got to start doing it, and that the first dozen or so are just going to be write-offs, and just get them done and get them out of the way, and then start. I love that. I forget which movie it is, but they talk about the American businessmen. They make these great leaps, whereas the Japanese businessmen, actually, it's Rising Sun, and it could be the book. Michael Crichton talking about it. He says that American businessmen make great leaps. Japanese businessmen kaizen, like they just keep on improving all the time. And I think that that's a great approach, but I think you got to do both. You got to try and make the great leap, and then when you make the great leap, you got to kaizen as much as you can. Just tiny little improvements over and over and over again until you get something that's where you want it to be. Because if you wait to launch when it's kaizened, you never get there. It never launches.
There's a push and a pull to that, though. We've talked about what am I doing and where does it go, right? And I would not have been ready, certainly, to run Outside Capital 2 years ago, probably 12 months ago. I know that you're supposed to be like, oh, I'm the best ever, but I don't know for certain that I'm ready today, right? I think I'm a lot closer than I was, but I only want to pull that trigger once. That's not something that I want to prematurely bet and then get better. And then the flip side of that is like, well, to your point, how do you ever know you're ready? I think I know that I'm a lot closer than I've ever known before. So,
well, here's a good question. What is the difference between running outside money and running your own PA?
Other people's risk, right?
Yeah.
I mean, you've got people work really, really, hard for it. And it's one thing to lose. I think I could pick myself back up. I don't want to be responsible yet for other people needing to do that. And I don't think that I would do that to them, but I only want to make that bet once. And I'm sure everybody else only wants me to also.
How about you, Jake?
The difference for me is the level of responsibility that I feel. Kind of like what Bill said, like, that you could work harder later if you had to, or take a different job, or, it's your fault if you lose it. But I think maybe the reputation part for it would be really hard to do poorly and wash out. You would just feel so bad, like you're letting down all these people who trusted you. Like that's an awful proposition.
Yeah, in practical terms, I think what that means for me is that I would size everything much smaller, and I'd have much more diversified portfolio for Outside Capital. I would never size anything. I've seen some guys who come out of the blocks really quickly because they're very aggressive, in positions that are volatile and slide around a lot, and they put a lot of capital into them. and get a little bit lucky sometimes, get a great track record, and then, never ever, and that's luck, but then never diversify out, consolidate, never do anything like that, and just run into a brick wall. Massive trap.
Yeah, well, and it's so important to have it's you have to be in the position to do it, but having the right partners is, I think, crucial to being successful, especially if you're running a concentrated book, because concentration works real well when it works, but when it doesn't work, you better have people that believe in what you're doing, because then they'll just run from you, right?
Toby, you've done different modes of investment vehicles. Do you feel different levels of responsibility between them?
So no, I don't. I think it's the same. I think it's the same level of responsibility. I've been looking for a way I'm looking for a structure that matches the way I manage my own, the way I manage money, the way I manage my own PA. And so I have finally found that, but that's a process too.
Well, I feel like too, with your approach, like, you tell people exactly what you're going to do. You show them why it's worked in the past, why you expect it will work in the future, and you do it. And if it doesn't work out, well, shoot, what were you supposed to do? Like, I did exactly what we all agreed was the right thing to do.
Yeah. I mean, that doesn't stop it from not working out, though.
Yeah. Well,
yeah, but that's
they can't
what
be mad
I love.
at you, though.
Yeah, and what I love about your strategy and what Jake and I have talked about, right, is it's like you just kept peeling back the onion, got to your answer, and then you're like, this is it. This is my answer, right? And then to Jake's point, it's transparent.
Yeah.
Nobody, that's
what
I
I wanted
to ask much more.
Because the reason I did it that way is when I started out, who am I? And why would anybody trust me at all? I have no expectation that anybody would. So I'm going to say, look, this is the process that I go to come up with the answer that I have, and this is what I'm going to. And my definition of a skillful investor is one who executes on the program that they've told everybody else that they're going to do, that the food inside the can matches the wrapper on the outside of the can. That, to me, is a skillful investor. I told
Hope it's not dog food, though, you're feeding him.
Well, but the idea,
as long as you're willing to eat it.
I didn't say it was necessary. Did I say it was dog food? It could have been like Chef Boyardee. It could have been something like that. Something really nice.
No, that makes sense.
I said to my wife after we had launched and everything was going, basically according to plan. I said, this is really nice. Like the strategy tracks value pretty well. And she said, I didn't even know that there was a risk that could not happen. I was like, yeah, sorry, that was also a risk.
Well, the other thing that's tough too is how many people have managed through a real drawdown?
What are those?
Virtually none.
What is this that you're talking about?
Yeah, right. October to December, that's a joke. I mean, that's not real pain. I mean, that's temporary indigestion. I'm talking like pain.
I think that's a good segue to actually. This is what I was thinking about. My topic was the markets. I think I saw somewhere it's a 29% year for the S&P 500. Is that right?
Feels a little high, but it might
30.
be. December's been strong, man.
So, and I think it was the best year since like 2013, which was also like a 30% year, like stunning returns. And those are compounded. There's been no drawdown. The 2019 is coming off a higher level than 2013. Every central bank in the world is printing. I don't know anybody other than the guys who are perma bears who is even remotely bearish. And my instincts are always wrong, so I'm always slightly bearish. But that's probably, there's a little perma bear in me too. But I just kind of get this feeling like we're going to run into a brick wall, just because there's not every single person is on one side of the boat, and all the arguments are so strong for being super bullish. Nobody's even thinking about, what happens if we go down a little bit.
I was messing around in the Apple stocks app, and I happened to notice that if you kind of pinch your fingers together, it'll show you returns between 2 points in time. And I'd never done that before.
Yeah, I didn't know to do that.
Yeah, so then I was like, I kind of looked at I was just on the S&P 500's map there, and If you go back to January of 2018 to today, we're only up 12% from there.
Okay.
So if that's like a 6% return basically compounded over the last 2 years, which is about what the average you would expect on any given random year for equities. But boy, isn't that just like what you would also expect? Like the path to get there, like crazy monster drawdown in, well, relatively speaking for this bull market in late last year. And then just a year that comes out of nowhere that's up 30%. And that's how we get to 6% annualized for the last 2 years.
Yeah.
This is a tough game.
Well, this is, people are going to say what they say about him, but I think Ken Fisher is one of the best writers on this subject. I mean, he always talks about, average on paper is not how you get to average.
Right.
And I really like his way of picking what next year is going to do. It's sort of cheating, but he basically looks at what everybody says the year is going to do, and then he figures out the bands that no one's picking, and he's like, that's the most probable outcome because that's the least likely to be priced in.
The band that people aren't picking?
Yeah, so like, you get up big. I don't know what the definition of big is, right? But like he basically looks at it like you're up big, you're up a little, you're down a little, or you're down big.
Okay.
And statistically speaking, you're either going to be down a little to up big more often than anything. So his argument is you want to be long unless you're going to be in the down big drawdown. So I guess when he might argue that you should get nervous is when no one's looking at down big. That's
what does he say has he given his 2020 projection?
I can't read that, man. Didn't you know what happened to him this last year?
Yeah, I don't listen. I mean, I don't listen to anybody prognosticating about what's going to happen next year because no one knows. The only thing that those guys don't know is that they don't know, and so they know less than I do.
I think he's the best. I mean, I don't know. People say I wouldn't talk like he talks at conferences, but that guy's freaking smart how he looks at things.
I love the story that his dad, he talks about Phil Fisher in the intro to one of the Common Stocks books, and he says he got asked at some conference where you could win. I think it could have been a TV or a color TV. What was going to happen the next day, I think. And I think his dad said his dad was like up big, and I don't know what that meant for the day, but up big for the day, and then everybody else is like trying to come up with like a little move, like half a point or a point move, and he might have said 2 points or 3 points, one way or the other. And of course, that's what transpired. And he asked his dad, how did you know that was what was going to happen? And he said, I didn't know. All I knew was that I'd be the only person picking that number. And so when it happened, it looked like skill. And if it didn't happen, then it'd look like nobody would remember anyway. So maybe he learnt that lesson from his dad.
He might have.
He's just picking what everybody's not picking. And then if that happens, then he's a genius because he's out there by himself.
I mean, that is the way to bet it, though, right? If you kind of bet the don't come line and wait and no one else is.
It's definitely the way to bet. It's definitely the way to bet.
It's hard to see how people are wrong because you did just have a big spending bill. You do have an accommodative Fed. Valuations, like, I don't know where else to invest than to buy stocks. And I know that is like, what are you doing if you're doing it for nothing else? But I see stuff that I think is reasonable out there. So I don't know. It's hard for me to be in the down big camp, but if it happens, I would be totally not shocked, and I think people are going to freak out. And I have this theory that
definitional, right? If it's down big, everybody's freaking out.
Yeah, well, that's true. That's true. But I mean, you could see some drawdowns in a lot of these names. And there's a lot that's not rich, right? Or there's a lot that is rich. I say I see things that I like. I like certain setups. I think this is not investment advice, folks, but Spirit Airlines, to me, people aren't going to go nuts on Spirit Airlines. It's a good business model. They've done a lot over the long term. It's trading at a pretty reasonable price. I'd rather own that than bonds. So, there's some stuff out there that I see.
That
just came to mind.
Let me ask you guys this. What was the last pitch that you heard that didn't have like 12 caveats added to it about like, well, if this stays accommodative and X, Y, Z all need to break right. I just feel like every pitch now these days is like they realize that there's this chain of events that kind of have to happen and break the right way for you for it to really, really work out from this price level. Doesn't that seem to represent more of the majority?
I don't really look at outside
maybe,
pitches, so I don't know.
Okay. Maybe I'm just
sorry. I don't mean to not be able to give you confirmation bias. It could be the fact that I spend time looking at airlines.
Why am I here then, if not to get confirmation bias?
That's a good question.
I do wonder, like I think you bring up some good points though, that like if there was ever going to be a exogenous push from the call it the powers that be to keep the market high before an election, boy, wouldn't this be the team that would do it? Like Trump, we've seen a lot of rhetoric out of him so far. Imagine what he would be doing as the election draws near and the things he's going to be putting out to try to prop up both just the perceptions of the market and the economy and trade deals.
Doesn't he just ignore it if it's down? It just doesn't exist if it's
quiet,
down.
But yeah.
I was cracking up when Robert Schiller was like, we've never had a motivational speaker that's a president before. It's like, dude, that's what half the presidents have been.
They're all motivational speakers.
No one's been an open market cheerleader and, gone against the Fed or whatever.
What about Reagan? Reagan was just good hair, good-looking bloke.
Yeah, I mean, you're going to tell me Obama wasn't a motivational speaker? Like, get out of here.
That's the job.
It's ridiculous. Yeah, so...
it's the CEO job, right? We were just talking about that before. Was that before we were on camera? The CEO's job is to tell the story.
Yeah, and, I think Trump understands reflexivity as it pertains to trying to get people out there and spending money. I mean, he gets that. And I agree with Schiller that he puts more focus on that than others. But he's not like the first motivational speaker that we've ever had. But I digress. But I do think that sort of goes to your point, Toby, that Robert Schiller's on CNBC saying, the Cape's pretty high, but like also Trump's a really great motivational speaker, so we can go higher. Like it's interesting. Everybody's pretty bulled up right now. Fear and greed is at like 97 or something stupid like that. But this
it
time
feels
it
very
happen.
weighted to one. Just the boat feels to me to be filled up on one side, and I feel pretty positive too. I'm not immune. Like I feel good. It's been a pretty good year. We're clearly like where there's momentum going into the new year. I don't know how it kind of comes undone, and I don't see it coming undone. It's just I just get nervous when every single argument, aside from the guys who you know are going to say something bearish, like everybody's bullish.
I'm not like bulled up. I'm just not bearish.
I don't have a
That
view.
makes
Like
any
to be
sense.
fair,
Like,
I don't have a view. I just feel good.
my view is that we probably become Japan, right? And how I'm wrong is like maybe the bluegrass capital view is correct, and we're in the middle of a, revolution, the fourth
Technological
industrial
revolution.
Yeah, and these deflationary impacts take a lot of the inflation out for a while, and then once everybody has captured the market share and start to raise price, then inflation comes. I mean, that's plausible. I don't know.
So the tweet,
What the hell
the
do I
tweet
do with
storm that you were going to discuss, Bill. I'm just going to jump the gun a little bit, but the tweet storm that you had, Lizz, LA forever, had one of the tweets was because interest rates, because people are living longer, and we're maybe at some tipping point where people can maybe live forever. Interest rates in that scenario go to like virtually zero, which is why, and because the market is a discounting machine, market's a forward-looking beast. We've already kind of started discounting to zero. How do you feel about that?
Didn't the U.S. just our longevity like tick down for the first time in 50 years or something?
Again. Here comes Debbie Downer.
I know. I'm just
Come on, man.
That might be the average, though.
Yeah. No, I'm saying
deaths and
it's like the
childbirth.
first time in forever we actually like you're the next group didn't live as long as is not projected to live as long as the cohort before it.
Did the Japanese live longer than everybody else? They got to that zero interest bound before everybody else did.
That's right.
So maybe there's something to it.
Jake, I think
Maybe.
your point. I think that's drug related. I could be wrong, but
Maybe.
I jumped the gun a little bit. Do you want to introduce your topic, Bill?
no. Let's just start talking about it. This take that she had. I mean, look, this woman is obviously really intelligent. That particular take, I thought, is like way cooler to talk about than real. I don't care if humans start living for 200 years. They still can't delay gratification. Like, I mean, what? You're going to tell me because I'm going to wait 200 years to die that I'm going to not want to have something now? Like, get out of here. That's anti-human.
It's not YOLO.
It's not YOLO at all. And if we know anything, it's that YOLO is strong to quite strong these days.
So we're talking about there's a great, how many tweets in the tweet stream? 87 or something like that.
100.
I think it's up to 100.
100.
100. Yeah.
Lizz
Yeah.
LA Forever is the Twitter handle, and there are several great tweets that you're going to mention, Bill.
Yeah, the two that I thought were really interesting, especially on the back of our buy trade sell segment, was she said, well, it's three. So company are like 17, 18, and 25, I think they are. Company narrative metagame management is one of the primary roles of a good CEO, and most do a poor job of it. Managing your narrative is a big aspect of capital allocation and can create or destroy fortunes for your shareholders. Then she goes on, this is why Elon Musk may be one of the greatest CEOs of all time, especially if you think Tesla is worthless. Narrative management and capital allocation alters intrinsic value. And then she keeps going and she says, in highly reflexive businesses, short sellers are kind of like economic terrorists by reducing the range of possible intrinsic value outcomes. And I think that's pretty interesting. Like, look at what is Amazon if Bezos doesn't know how to deliver that message to the street from day one? What is Netflix if Reed Hastings doesn't know how to deliver his message and get that leash? What is Disney without Iger right now going through this transition? There's a way to see Disney where they got in a bidding war with Comcast. They overpaid for these assets to get Marvel because they're desperate to get growth. Disney Plus is like an offset to ESPN, which has massive headwinds, and Disney's failing. But, like, Iger's there, and he's got this sweet book, and he's Iger. And that stuff, I don't say that, like, that matters, right? And
He's
it's
very
all true.
likable, Iger.
That's right. And, like, he's a visionary, and he did – I'm not sounding proper because the Pixar – deal was super forward-looking, and he's done a lot of really good things. And I'm not trying to be sort of denigrating to his record, but I do think that him being there totally changes the lens that people are willing to give to the company, and that matters a lot, especially when you may need to go out and do an acquisition, and stock is your currency or potential currency. And Buffett, it's super hard to argue that him at Berkshire has not been a massive benefit to all the shareholders, in addition to his allocation skills, who he is getting them through the Solomon crisis and whatnot. I mean, all that stuff really matters.
Do you think we know the term value investing if Buffett doesn't exist?
Probably not.
Do you think that Graham and everybody else is kind of... and that there are practitioners who get it directly from Graham rather than, like, I think everybody from the last generation or two has got it from Buffett, right? Read Buffett's letters, then go backwards and find Graham. But there are a handful of guys who are Graham first who'll probably... Do you think that their records were good enough to kind of... Would it have survived to this point?
Yeah, I think their records are good enough. I think Buffett, to me, is a unique combination of a guy that wanted it so bad, had the skill set and the brain to put it all together, condense it, and package it in a sellable format. And something in him wants to be liked bad enough that he was willing to do it. So I think in order to mass market a concept, you need an idol. And he's a great delivery mechanism for the message.
I think don't discount his want of teaching also.
Yeah, that's right. Okay, that's fair. Sorry, Buff Dog. But, so I guess that there are other standalone records, like Greenblatt, for instance. His record clearly deserves to be in the discussion. He wrote the books, but he doesn't have the same way to get it out to the masses. So maybe it's 'cause he's just not as rich.
My guess is that it would look like the current amount of followers of spinoffs and ARB.
Yeah, and there's not a lot of those guys around.
Not a lot.
You know who does it well? I wanted to bring them up. That dude, Cadis, whoever runs Cadis Cap on Twitter, they post really interesting ideas, and they've been long Bed Bath & Beyond and Tesla in the past year. So, like, they have some real
range there.
Yeah, it is range. Now, maybe that's luck. I don't know. I don't know the person. I don't know what their track record is, but
it's the Mariah Carey of investing.
But
that's
you don't find many of them. So
that was a great discussion. Corey Hofstein threw this out to Twitter. He said, "What would you pay, or how would you even analyze what you'd pay for Mariah Carey's All I Want for Christmas?"
$0.
Well,
I'll tell you what, I would pay all the dollars if I could make sure I'd never hear the song again.
Well, here's the hit. Because it's FinTwit, it gets into this. We got right into it, and the analysis is kind of interesting. So you can look at her Spotify plays. So that song is the most played song on Spotify, and it comes out every year, and it goes to number one. So her royalties from Spotify for All I Want for Christmas is $2 million a year, something like that. That ignores YouTube, radio, Pandora, I guess Apple, iTunes sales potentially, any other kind of format. So I don't know what she's doing altogether, but it could be like $5 million a year out of that thing. Now, is that a perpetuity that's growing? Is the growth rate higher than the discount? What's that thing worth? Like, that's worth a lot of money. There's still songs. We can still sing Bing Crosby's songs. They came out in 1942.
Yeah, there's a nostalgia element to Christmas songs where I don't think they decay like other things, other IP. I mean, you want to hear the ones from, like, what are all the movies that I like to watch during Christmas time?
Die Hard.
Die Hard, we're going to watch it tonight.
Obviously.
Because my kids are really into it. National Lampoon's Christmas Vacation, Scrooged, Christmas Story, and Elf is the only one that breaks this like decade or even this century.
Yeah.
So otherwise, it's all nostalgia, right?
I tried to get into the Santa Claus.
Mariah at this point.
You guys are all having the wrong conversation. The right conversation is how much would you pay to be Nick Cannon? That's the right conversation.
Should we do some?
The song's worth a lot.
Should we do some mailbags?
Yes,
because I got quite a few good ones from the mailbag. After not having many last week, after having 0 last week, we've got 3 good ones. So this is a good one. I want to be a better investor. In the past 2 years, I've read lots of books on investing. Mobison discusses in The Success Equation the concept of luck and skill. How do you know whether you're improving your skill as an investor? What are the skill sets you should be trying to build? That's from Leslie Chan, CPA, CMA.
It's a fantastic question.
Really good one.
It's maybe it's probably the question to be asking yourself if you're in this game for the long haul. Because, all the stuff that we talk about, is it a bullish or bearish time? Like, all of that stuff will pass. And we'll have new setups and new opportunities and new problems to solve. But the meta game of it that she's talking about, that's the real game to be playing, I think.
That's a man, Leslie Chen.
Oh, my bad. Sorry, Leslie. Genders.
Didn't mean to interrupt then. Sorry, keep going.
Yeah, so I think that is the important question to be asking yourself is what can you be doing to get better? And for me, I think it really comes back to understanding yourself deeply, because there's certain investment strategies that just make sense to you and are going to test your conviction to keep doing them all the way through when it doesn't work and when it does work, and it has to fit your personality. And if it's going to fit your personality, you have to know what your personality is to begin with. So it's a soul searching kind of a thing. Like it's that last liberal art that Hagstrom talks about. That it's why this game is so much fun, actually, and different for everybody, and lots of different ways to win, and even more ways to lose.
It's one of the few things that you can get better at as you get older. Like the professional chess players, I think their computational skill tops out at 37, something like that. And then they can win for a few more years just because they've got a little bit of experience. But eventually the next guy coming through is just a better computer of positional play. And so they start falling off in their kind of mid-40s. That's not true of investing because you're not timed for one thing, but you've got the ability. It's all just experience, right? Just reps. The more reps you do, the better you get.
Yeah, I mean, for me, I think you got to look at why you're winning. So if you're winning off multiple expansion,
2019.
What's wrong with that?
I mean,
what's wrong with that?
Is that something that's in your control, right? Or
yeah, if you buy it cheap enough, it is.
That's right.
That's
so
true.
is that part of your strategy? And that's what I think, aligning what your strategy is with why you're winning, and did I underwrite that? That's the important thing, right? If you're just sort of directionally, I have found writing to be super important for this, because it allows me to go back and say, this is why I bought something. I have stuff in my portfolio now that's like, I mean, I've had it for years. I wasn't writing at the time. I'm happy with the position, but like, I don't know. I mean, I was right, I guess, but I don't know that I was right. Like, I know that I was right for some of my current positions, or wrong for that matter.
Yeah, I agree. Writing the idea down, writing the thesis down is important.
Yeah, because I mean, even AB InBev, like, God, I hate owning that freaking thing. But I look back and I mean, it's doing better than I underwrote. And, I didn't expect all the financial engineering this year and the volatility in it, and having to be pestered about why I bet on 3G and what an idiot I am and why don't I own Heineken. Like, that stuff has gotten to my psyche, but the written thesis and the presentation that I gave on it sort of is, my version of a true north. So, we'll see if I'm wrong in due time, but that would be my best advice to you, is write your stuff down and, see what happens from there.
So I've got another one. This is a question that is about asset allocation. What's a sensible allocation of assets given how inflated all assets appear to be now? Read a bit of Meb Faber, but I'd love to hear your thoughts. That's Cameron from Melbourne.
We are so international.
This is not financial advice. Also levered and long, because YOLO. No, the way I run, my family is I have a certain amount of cash set aside that I think that we'd need for
living expenses.
For a period of time that we're comfortable with. I have a CFA and a JD. If I can't get some job, I think I'm probably doing something seriously wrong. My wife has years of attorney experience. I'd like to think she can go back to work. So it's just a personal thing. And then everything in addition to that, I have equities, because I just don't fundamentally believe in credit right now. That's a personal bias, but I think it's one that it's right. And I'm willing to die on the hill. The cash allocation is fairly large. Like, I'm not, and again, talk to financial
6 months.
advisors.
6 months of living expenses longer?
I have like 4.5 years, man.
Yeah, that's long enough already.
I need a cushion.
What's Jake? This is kind of more your wheelhouse, isn't it? What are you thinking in?
I don't have a for me, I mean, this gets back to Monier's, that repression paper that we talked about. Like, if you believe X, then you should probably be doing A. If you believe Y, you should probably be doing B. And they're like diametrically opposed and could both be right under different scenarios of the world that we don't really know what it's going to look like. So X and Y being rates lower for longer, or Y being that like we get reversion to the mean. Yeah, I mean, it's really tough. It does feel like there really is nowhere to hide. I'm thankful that we don't have also ripping inflation that is basically like increasing the ante of holding cash at this point. Depending on where you look, like I've seen some other like computations of inflation that aren't CPI, and it's like it looks at different cities in the U.S. and like just at the 400 things that people buy the most, basically, and it was like it's been running at like 10%. So maybe it is a little bit higher, and that does hurt a little bit more than to hold cash. But
is that a shadow stat, or is it something?
No, it was this other index,
a zero hedge index.
No,
you on the zero hedge index.
I wasn't looking at that either.
You don't think CPI understates the actual inflation that's going on?
There's no way it doesn't. There's no way,
okay.
Because everything that you want costs a shit ton more.
They also shrink. They shrink everything down on you.
Yeah, dude. Like, great. So my TV went down in cost. I could care less, right? Like, everything I want.
That's a hedonic adjustment.
A lot of hedonic adjustments.
Ticket, right? And like, they're going to tell me that that's not inflation because it's some discretionary item. It's what everybody wants to do. Like, anything that people want to do costs a ton more.
Yeah. So I think the argument is that for me, I'm trying to be patient and I have much more cash than would have ever been probably considered prudent over the last, call it 5 years. So I'm probably, when I say that it's not a wheelhouse, like I really meant it. Like I have been wrong for long enough to where it's like I have zero confidence in my own ability to predict which way is the direction of Monier's kind of gambit.
So how do you reconcile your cash position with like how Berkshire runs their stuff, or what Buffett would probably tell you to do?
Well, I do keep an eye on that, and I think I'm actually pretty close to the allocations of what Berkshire's balance sheet looks like, especially if you consider the cash as zero return bond paper. It's not that different. Like, granted, like they have a lot of more bonds because of regulatory reasons, but I don't think I look that much different than Berkshire at this point. Now, whether he would say you're too small to not look different than Berkshire, that's a different argument, and he may be right. Like, you're not working hard enough then to find. But then my counter to that would be like, I thought I'm looking for 1-foot hurdles. Like, if I have to work that hard for it, then like, what are we doing here? These are all 7-footers that you're telling me I need to find and jump over. So
can you do a Frosby flop? The Frosby flop?
I feel like I have to for a lot of these things. So I think I'm pretty close to what Berkshire looks like at this point, though. And I do keep track of it, and as a percentage of like how much cash do they have as a percentage of total book value. And I'm not far off from it, if that gives you an idea of the underperformance.
You got $100 billion in cash.
It's a percentage.
It's not fair to like judge your portfolio based on what would it be if it was 100% S&P, right? That
is a very spurious argument for sure.
Yeah, and it's like it way overstates.
I feel like it might be a good bet now, though. Next decade, that's a pretty good bet. I'll take it.
I would absolutely make the Buffett protege partners bet today. I think Buffett.
Ted Seides is just so happy. Ted, please be listening.
Yeah, no, I think Ted wins the next decade. He just happened to he got the wrong decade, and I think Buffett knew that actually going into it.
The bet was struck in 2009. When was the bet struck?
Maybe seven. I don't know.
Yeah, somewhere around there. I almost want to say the beginning of 8, but I might be wrong.
Toby, what do you think on cash?
Oh, it's hard. Yeah, you need some living expenses set aside. But where you allocate after that is the hard thing, right? There's nothing that's really good. I'm an equity guy. I only want to hold equities because it's the only thing that I feel like I understand or I have a little bit of an edge. It's like a guy who, if you're a professional hold'em player, don't sit down for PLO, but don't sit down at the blackjack table. Like, you got to do what you know how to do. And for me, it's one thing. I know equities, and so I think that I don't look at equities and think, well, this equity is going to give me 7%. I look at the equity like, well, it's got some cash, it's got some assets. Like, I get a feeling for each one of them. And so I want to invest on that basis. So I know. Do
you actually specifically look through to do you kind of think like my percentage ownership of this company therefore makes my balance sheet look like this?
No. I'm not bringing their assets onto my balance sheet.
Okay.
No. But I just look at I'm looking at each one as its own risk-adjusted bet. That's how I'm thinking about it. And so I'm just making sure, they've got excess cash, they've got some assets, they've got some cash flow. I feel like that's, and if the management has some evidence of buying back stock, I feel like if the market really gets beaten up, use the free cash flow to buy back some more stock, we're probably going to be going ahead, even though on paper we're probably down. As an investor, I'm going ahead through a period like that.
I mean, the tough thing on something like this is, like, we're podcasting, we live this stuff, right? Like, if it's a listener, I don't know how much you live this stuff, and I would just really encourage people to, however much risk tolerance you think you have, back off of that number a little bit, because there's nothing worse. The bad decision was sort of made earlier. And there's nothing to do now, so
now's the time to think about it. At the top of the market, now's the time to think about it.
So, like,
if you're down 50% next year, how are you going to feel? Can you survive after that? And maybe it doesn't recover. Maybe it does a Japanese-style swan dive, and it's 25 years away. That's what you got to think about. It doesn't necessarily look like 2009 when it bounces like a golf ball off a concrete path.
Yeah, and if you underperform a little bit, who gives a shit? Like, I mean, what are you really trying to compound for? Like, it's not, you're not
Glory.
in some race against Buffett. Yeah, well then you're probably going to get your face ripped off at some point, right? So get ready for the punch.
All right, I got another question. This is a two-parter, so buckle up. Given the best investors are wrong even 1/3 of the time, I think that's wildly bullish. I think the best investors are wrong 1/2 of the time. Should we just invest based on a multiple alone, or can we do better using a checklist and trying to understand the business dynamics? Yeah, let me be clear. You can definitely do better trying to understand using a checklist and understanding the business dynamics. I would never just use the multiple alone, and my screeners don't do that. I don't do that. But off to you guys.
I think I think there are a couple smart ways of doing it. Like, it's a sliding scale of concentration for me. How much do I have to really understand about the business to how much would I be willing to concentrate in it? I think if you use a more of kind of like a Walter Schloss approach, where he probably had 100 stocks at any given time, and all of them were just, let's just say, low, some multiple, whether it's PE, book,
yeah,
something, yeah.
You think he was more than book?
I think, yeah. If I recall correctly, like, they looked at some other stuff than just that. He was a tiny bit more sophisticated, I think, than people give him credit for. And if you're today's Walter Schloss, then kudos to you, as Bill likes to say.
He is today's Walter Schloss.
So that's kind of one end of the spectrum of things that I think are intelligent to do. You're just very diversified. You're owning a basket. And really what you're kind of doing is approximating the value studies that have done so well. Now, on the other end of the spectrum, you concentrate. You know everything about the business. You know the sock size of the the CEO. I'm in jest a little bit there, but I do often wonder, and maybe this kind of goes into it a little bit more, but I sometimes wonder, when I'm doing really deep due diligence on a company, am I adding to like the relevant knowledge at a slower clip than I'm adding to my confidence in the idea?
Right.
And there's got to be some crossover point where I'm not really learning anything that's that useful for understanding the business and the returns, but I am adding to my confidence that, like, I know everything about this. And that's, I think, is actually, you can find yourself in a problematic place.
I was just listening to an Adam Robinson, Tim Ferriss podcast about this exact issue where horse handicappers do better or as well with like 3 pieces of information as they do with 40, but their bet size goes way up with 40. So, I would, I don't know. I think you got to figure out what you can stick with. I think that if you're going to be a discretionary investor, you got to do enough of your own research that when the market tells you that you're wrong, you're not looking at the stock price to figure out if you're wrong. Because in my opinion, that's the best way to lose money out there. Whatever that is for you, I have no idea, right? I know for me, it really depends on the idea. I mean, the airlines took me like 7 months to get my head around. I've been stuck on this freaking restoration hardware thing forever. I'm probably not even going to buy it, and I'm still doing it. And then there's been other things that I bought literally in a day. But it's been because it's been something I've sort of followed, and then one day it just clicked. So it's not really just a day, but I don't know. Fact is, you got to be able to staying power, in my opinion. You own a business, so you can't get scared by the price of the business and sell the business.
I put that study into quantitative value, the horse racing study. And there's another interesting one as well where they think it might have been on betting on college football games. So they asked a whole lot of kids, how closely do you follow college football games? And they found the ones who did follow it. Then they got, what data points do you look at to determine who's going to win? And they collected all those data points. Then they randomized them. So everybody eventually got the same data about each, the game, the matchup, but the order in which they were given the information varied. And what they all tended to do was they anchored on the first bit of information that they got, and then they didn't update as they went along. And then there's that other one, the horse racing one, where just the more information you get, you don't get more accurate, you just get more confident. Yeah. So I think it's really interesting. When I read the snowball, the thing that really stood out to me is the way Buffett analyzes a company. Basically what he's doing, he's looking for a reason not to invest. He's just combing through. And what I've heard is he doesn't like the CEO, so that's gone. Doesn't like whatever, some arrangement, gone. Doesn't like something, gone. Like that's what he's trying to find a way to reject. And that's kind of interesting because I think that you probably only need 3 bits of information, maybe you need 6 to work out whether you want to be long. And then you should have a list, and I know that Monish Pabrai does this as well. He's got a list, and I think there might be 80 questions on it, and he goes through the 80 questions trying to cut something out. I think that's an interesting way of investing. I think that's a smart way of investing.
Yeah, Munger's actually talked about Buffett's disqualifying checklist.
What's on it?
It's doesn't like the CEO, too much tail risk, and I think profit margins. And those 3 things, like if any of those he decides he doesn't like it, there's no balancing out anything else that he could look at. He just moves on. He's done. And so there's no, like, oh, well, but I really like this other part. And now it starts getting complicated in your head of, weighing the pros and cons. He has like just deal breakers, and those, he just abandons ship right away. Doesn't even go on anything else. So I think that's a pretty interesting thing of putting together your own disqualifying checklist, that it probably keep you out of talking yourself into the occasional bad idea.
Part of the reason that I invest the way I do, which is more systematically than you guys do, but it's because there's a great book, I think it's called Winning the Loser's Game, and it's about tennis at a professional level. When you see it on television, those guys are trying to hit winners, right? You can't win if you can't hit a winner because they don't make many errors. But at an amateur level, you win by not making errors.
Just get the ball back over. Let them make the mistake.
Exactly right. You just keep on let the other guy make the mistakes. And I think investing, like if you can just remove the unforced errors from your game, you're right up there in elite company. You don't have to have a brilliant insight. You just have to not vaporize part of the portfolio.
I think about investing like I think about fantasy football a lot. So, like you can blow your entire fantasy football year if you get a high draft pick wrong. You're not going to win it, but you
can
can
lose
definitely blow it. And then you can win if some of the later round picks really sort of develop into something that you didn't see. So especially with my bigger positions, I try not to lose.
More certain rather than more upside.
Low variance.
Right. And then I don't run like, I have a tail of some positions that I hope can sort of surprise me to the upside.
Sleepers.
Yeah, that's right. And that's where a lot of my portfolio churn is found too. Because maybe the guy had to get sent down. We'll see you later. Go work on yourself. So I don't know, but that's my theory.
I think it's a good question, though. I mean, and it kind of goes back to the previous question about understanding yourself. And all these questions tie together in, if you're down, do you have the conviction to buy more, or do you get spooked out of it? What is it that you're going to rest intellectually on the bet that you're making? Like, is it that you trust that the studies will work out, or is it that you trust that your understanding of the business there's something unique about what you understand? So you have to have something in that realm. Otherwise, I think you lose this game. But that something can be a lot of different things in a lot of different ways.
Yeah, well, I think that the hardest thing, I was just talking to somebody about this weekend. The hardest thing about public market investing is every single day somebody's telling you that you're either right or wrong. And you have to not care what that person says.
When you say somebody, do you mean somebody on Twitter, or do you mean the market? Yeah.
Well,
aren't those the same thing?
Yeah, yeah. It depends, right? How public you are with what you're doing or whatever. But the market, at a minimum, you can always check. And if you're getting your satisfaction about, whether my portfolio is up or down, that's a very hard game to continue to win at. I think.
Do you check it every day? Do you check it all day, every day? Yeah.
I check every day. I don't check all day at all. I like to tell myself I just see if something big is happening in the portfolio, but I like to know.
You like the dopamine hit?
Yeah, I do. But honestly, part of me knows that about myself. So I think I'm relatively good at managing that. Somebody listening is probably like, oh, that guy's an amateur and he's going to screw himself doing that. Well, sorry, you do you, man. Or lady. So we skipped. What do we think about the Geico news?
Let's do that. What do we think about the Geico news?
Taking over it.
So he's managing $14 billion. He's now the CEO of Geico, and he's the liaison to the J.P. Morgan, Amazon, Berkshire healthcare initiative. Man, this dude's wearing a lot of hats right now.
Yeah, he is.
Which Todd is it?
Well,
yeah,
it's Todd and Ted. Yeah, so Todd Combs and Ted Weschler, right? So,
are those the same name in Australia or something? Because every time you
said it twice.
I didn't know. I don't honestly. I don't watch Berkshire that closely. It's just not that relevant to me. But
Todd and Ted.
Sorry. Yeah, that's
it's fine.
My bad. Apologies.
Is it our accents? Is that the problem? You can't recognize the difference?
Culturally insensitive.
I think it's hard to figure out what it all means. I understand why he would still run the $14 billion. It's hard to transition portfolios, and if he doesn't have a lot of churn, I would do the same thing. I don't really know what it involves to run Geico. It seems to me like that's a really well-oiled machine.
You have a Jeet above you too. He's in charge of all the insurance companies. So there's still training wheels there.
Yeah. I mean, man, I don't know. I don't even want to say this out loud, but I wonder how Ajit's health is, and whether or not it's time to start getting somebody under Ajit that.
How old is he?
Take that over. I don't know how old he is, but I don't know what I'm talking. I don't know what I'm talking about here, but when he stood up and he was at the meeting, I mean, he was shaking a lot, and I just don't. They don't put those guys up, so I don't even know the questions to ask, right? And none of that's disclosed, and it shouldn't be. He deserves privacy, but it's just one of the thoughts that I had is maybe this is part of getting Berkshire ready. And
could have been nervous. I don't know.
Yeah, could have been. It didn't look it. It looked health related. But I figured, okay, well, this clears sort of the way for Ted to take over the public investing, and all systems go.
So does that change the handicapping on who's the front runner for operations replacement?
I don't think so, right? Because I always
Still
think
able and
like Ops Co,
Jane.
Insurance Co, and then Float Co. So I think Ted is Float Co if he wants it.
So we have wrung all of the juice out of this week's episode. Should we declare it? Declare the meeting closed?
Happy holidays. Happy New Year.
Happy New Year.
All that.
We're going to take a 1-week break, and then we'll be back the second week of January.
Send us your questions, please.
Questions to Jake, insults to Bill, and compliments to me.
Sounds about right.
Yeah, it does.
See you guys.
Move with the rhythm, shake it up, stop when the clock hits 13. Sing